Welcome back, investors, to Ticker Time News. I'm Adam, and today featured a choppy, range-bound session that saw the S&P 500 basically flat as a pancake, while the Dow Jones, ticker DIA, was green just barely, and the Nasdaq QQQ was trailing, down just over 0.5%. The SPY held just a few points above its lower end of its weekly expected move, as we predicted it would yesterday, as market participants await the almighty Fed Chair Powell in his speech tomorrow at the Brookings Institution, which is entitled Economic Outlook, Inflation, and the Labor Markets. Whoa! All the ingredients for this market: economic outlook, right? The recession that's incoming, the big drop that's incoming, inflation, and labor market. Yeah, those are the two mandates of the Fed. Get inflation down and stabilize and keep employment full. That's what he's talking about tomorrow, and those are the mandates and what the Fed does. It is just mind-boggling, right? They leave these little breadcrumbs and clues for us to digest and dissect and figure out. It is so crazy. But the market basically is holding its breath, holding on that Jerome Powell, does not become ultra hawkish. That's right, ultra hawkish. If he becomes ultra hawkish tomorrow, this thing's done. You know, put a cap on it, a lid on it, put it in the fridge. It is done. Thanksgiving is over. Now it's time for some bad news. I don't know, but maybe ultra hawkish tomorrow. If not, then I think this market may have priced in potentially, if Jerome Powell is not overly hawkish tomorrow, the market may have priced in already what he may say. Now, that speech will influence the market's policy path expectations for the remainder of 2022 and starting off 2023. Of course, what he says at the next FOMC meeting, which are December 13th and 14th, that press conference on the 14th in the afternoon will also set the expectation and continue on the path that he sets tomorrow. Now, this led to a whole session taking place on lower than average volume. Looking at this heat map here in front of you, you can easily see this nice visual of today's market and the big players that moved this market. Look at the red spot. Apple over here, bottom left-hand quarter, down 2.1%. It is a huge $2.2 trillion market cap company. When it moves, the market moves. It's down to $141.16 a share right now. Yeah, CrowdStrike earnings. I'll talk about that in just a moment. Look at Google, Microsoft up here. Both of them, Alphabet down nearly 1%, 0.9. Microsoft about 0.6%. Hop over here. Amazon down 1.6%. That's another big one. Tesla over here down 1.1%. United Healthcare, another big red one, big mega cap. It's 0.8%. And then you can see, look at finance today. The finance sector did pretty darn good. Okay. Also, transportation, that is very important. Little down here. The weight of each, I love this heat map. This is from TradingView. I absolutely love it. It's interactive. You can play with it. It also shows you how each sector is weighted within the S&P 500. So you got the big dogs over here like technology. Financials are a big one. This is also part of technology. You got electronic technology, technology services. You get over here, transportation, much smaller. Industrial, much smaller. So it's pretty cool how they break this down. Okay, let's go over, was this it right here? The This is the economic calendar. My apologies. This is not what I wanted. I want over here to open this up. I meant to leave this open, but I didn't. We will come back to the economic calendar in a few moments to talk about this. But look, this is earnings. Okay, so all right, it needs to load for just a moment. Where's the there we go. There we go. Today. All right, today. Now I'm going to sort this by market cap, largest to smallest. So Intuit, it's a company I love. I like this company. This is your QuickBooks, your TurboTax. Intuit owns that. They just recently, within the past couple of years, bought an email marketing service. Oh, what I can't think. It's a monkey. I can't think of the name of it off the top of my head. It's just blowing me away. But I love this company. I think it's great. You can see here that they did beat on earnings with the revenue forecast of 2.4 billion. They came in at 2.5 billion. So really good. CrowdStrike right here. They also came in really nice. They beat by 8 cents on EPS. Revenue forecast was 575 million, and they brought in 580 million. Now, here's what I'm going to say about CrowdStrike. What you have right here, what you said, recession proof, okay? 2 weekends ago, so there's a video out right now on our YouTube channel about Palo Alto Networks, okay? Let me see here. I want to go here. Give me a quick second. I want to get this video. And the reason I'm going to get this video about Palo Alto Networks is because they too, just like CrowdStrike, are setting up to be recession proof. Your quote there about recession proof is spot on. I think CrowdStrike and Palo Alto Networks could be nice, reliable companies as we go into a recession. As a matter of fact, here it is. What I'm going to do is get the URL here. Nope, come on, work with me here. I'm going to get the URL, get the link right there. Just double check. Okay, got it. I'm going to put it in here just in case you guys haven't seen this video. This video right here, that's the link to the video right there. It's about Palo Alto Networks. Now, I go over Palo Alto Networks and their chart, and I'll pull it up right here. The ticker symbol for Palo Alto Networks is PANW. As a matter of fact, here, let me just do this because I don't want to mess that up. Let me come over here, make a, open up a new chart, and we'll go to Palo Alto Networks and then look at CrowdStrike. I believe that recession proof. And in the video on Palo Alto Networks, I lay out why, okay? Using their data from their earnings report about the cash flow, about the cash they had, about what they said about their customers, about their deals and how their deals are being structured, how they're turning customers over to a recurring revenue stream. So a lot of good things. Cash on hand was another one. Okay, PANW. When you look at the chart here for Palo Alto Networks, I want you to notice something specifically over the past couple of months here, about 6 months. I'm going to go to the daily time frame. So for the past 6 months for Palo Alto, all right, let me get it on here. Here's their earnings right here. Okay, right here's their earnings. And you can see they had a real nice gap up, But if I were to draw a line like this, I know it's not very straight, and do the same on the bottom like that, this is 6 months worth right here. What has Palo Alto Network done in the past 6 months? It's gone nowhere, right? If you bought this thing 6 months ago and you're still holding it today, well, you've actually gained quite a bit, okay? So 6 months ago, you would have bought down here at the bottom of this basically range-bound trading, and today you'd be up here. Now, it's not huge gains, but you would at least be up on your investment buying this 6 months ago. You know, if you bought the stock market 6 months ago, I don't think you can say you're up on your investment. When I say stock market, I mean like buying the SPY or the Qs. You can't say 6 months ago to today that you are up on your investment. Palo Alto Networks is. Now, let's do this. Let's go over to CrowdStrike. I want to clean this up real quick. Let's go over to CrowdStrike. Let's go over to the earnings calendar. And from here, you can just click on it. It's going to open it up. A smaller chart, but we can go see the big chart here too. But I just want to show you this real quick. Take a minute to load. Open it up a new window. Just give it a moment. It'll load. Ticker for CrowdStrike, CRWD. Now, for CrowdStrike, a little bit different. If we want to, we could say from back here in May, after this huge drop in May, going to today, you're basically the same, right? All right, let me do this again. Going back here in May, okay, on May 11th, at $137 a share, fast forward to today, is $138 a share. So about a buck, about a $1 gain buying back on that low point in May to today. So really over the past several months, CrowdStrike has gone nowhere. I do think Palo Alto Networks is a bit more, how should I say this? Has a better foundation than CrowdStrike. So I do like Palo Alto Networks a little tiny bit more, but I also like CrowdStrike, okay? Just a couple things to point out. Watching the video on Palo Alto Networks will help to understand some of the industry characteristics and what's happening in the industry, even for CrowdStrike, okay? Cybersecurity, huge. And just think, you have small, medium businesses. Even during a recession, you need your basics, right? You need your utilities. You need electricity to run and operate your business. If your business has any data whatsoever, that data has to be protected, all right? If you are a small business owner and you own a, I don't know what you own. Maybe it's let's go with you own a grocery store, right? You have data on all of your products. You have data on your customers, what they're buying, what needs to be restocked, the whole 9 yards, right? You need to secure that data. And if you opened up a grocery store or a corner store, whatever the case may be, you're probably not that well versed in protecting that data, protecting that online data, or that data that you have in your server, in your closet, in your office, okay? So you're going to have to hire somebody to protect that data for you. Well, the bigger your company is and the more data that you have, You're going to go to Palo Alto Networks. You're going to go to CrowdStrike. You're going to go to these cybersecurity companies to help you protect that data because it is so vital. Okay. It's vital to your business and your reputation as a business, because if you get hacked and you have customer names and credit cards on file, watch out. Be careful. Okay. So that's got to be protected. And if you just left it unprotected with a simple, password that's got your birthday, your date, your, I don't know what number, 1111, then you're in trouble. So I can see why they are, and they can probably get away with saying that they are recession proof, because they are becoming more and more and more and more of a standard, as something that is a necessity for business. Now, Palo Alto Networks also stated that even though customers are getting a little picky right now, deals are taking a little bit longer to close because customers are looking for discounts. They're looking for deals. How can I make this contract a little bit better? They're not canceling though. Even though they're looking for discounts, they're not canceling. So that's a big deal. That's a big point. Watch that video. That video will help you to understand better Palo Alto Networks, cybersecurity, and in doing so, it'll help you to understand CrowdStrike a little bit more. But we can, if you would like, maybe I can dive into CrowdStrike and do a video about CrowdStrike in their earnings report, like the Palo Alto Networks video that I did. So check that out. If you want me to, just say do it, go, and I'll start diving into it more, and we can most certainly do that. Okay, back over here real quick to, I don't know why I just deleted that earnings. We'll pull it back up in just a moment. Now, Apple. I want to talk about Apple for just a moment. Down here on the bottom left side, AAPL is the ticker, down 2.1% again today. Apple took this sharp turn lower amid ongoing worries about potentially large iPhone 14 Pro production shortfalls this quarter. Again, we're talking about Apple and their shortcomings. The majority of it has to do with the unrest in China and Foxconn, a manufacturing place for for Apple in China for the iPhone, and the iPhone 14 Pro specifically. Now, how do you think that's going to translate to earnings for Apple? Do you think Apple is going to beat on earnings when they report? What do you think? Do you think if Apple is going to have a 30% downfall in iPhone 14 sales, is that going to affect their earnings? Absolutely, it will. And it will affect them in the negative, okay? Looking at Apple right here on their chart, this is them right here. We've got price to earnings ratio of 23.6, a market cap of 2.2 trillion. January the 26th is their next earnings. Right now, the trailing 12-month EPS is $6.14. They're trading at $141.17 a share. Okay. All right. That's Apple. It will hurt their earnings. All right. Now, this is TradingView. I started to dig a little bit deeper on TradingView to find some things that are a little bit more, what should I say? appeasing on the eyes instead of just staring at charts the whole time. I'm trying to dive into TradingView to find some visual aids to talk for what we are talking about. That way it helps you to visualize what I'm saying as well. So that's something that I'm working towards and trying to do better on. So that's why you're seeing some new things pop up on the screen today. So I hope you like that. All right, Apple here. Here's their chart. Big rise up into August. November has been choppy, real choppy for Apple. As I get my highlighter out here, you know, we could literally draw a band, not very good one, you know, and Apple is range bound. You know, it's not really going very far at all. Now, let me open this up here just a little bit so you can see we are, you know, 57 days away from their next earnings report. But I cannot imagine, unless all of this talk about production slowdown or shortfalls, I can't imagine that's going to be good for earnings. Absolutely. Look, you are absolutely correct. Delusional analysts will say Apple will beat earnings next time and keep it at a buy. You are correct. I can't. If you're going to lose 30% of your sales, how are you going to beat on your next earnings? How are you going to do better than your previous earnings if you're going to be down 30% or as much as 30%? Okay. So Apple, I don't think it's a safe bet right now. I really don't. I think Apple could be in trouble. And if you look at Apple, let me take these highlighters off here real quick because I want to show you this. I want to show you this. I'm going to go back to the beginning of 2022, okay? And when we go back to the beginning of 2022, even look at this. Let me just bring in December, the low right here. So we had a sell-off from September right here from, all right, highlighter. Okay, from September of 2021 all the way to third quarter of October, down. Guess what? If you bought October of 2021, that would be right about $139 a share, and Apple's at $141 a share. So just a couple bucks. Riding through all of this chaos just to be right back to where you started. That's incredible. So let's see here. Where is January 1st or January 3rd? It's literally the top right here. Right here. This is January the 3rd when the first day of the market. So from there, and we draw this line, I know it's not perfect, down to where Apple is right now, it's just been declining. It's in an overall downfall, just like the rest of the market. So I do not think Apple is safe. I think Apple is not going to be a good bet going into 2023. Now, today, there were some other mega cap stocks that suffered losses, like we talked about at the beginning, and they, of course, dragged down the main indices. Now, the Vanguard Mega Cap Growth ETF, ticker symbol MGK, it was down 0.9%. You compare that to a 0.2% loss in the S&P 500, and you can see mega caps did worse, and it's visualized perfectly here on this heat map. Now, let's talk about the VIX for a moment. Let me open up another tab here, okay? Another chart, and let's go to the VIX. And the reason I want to go to the VIX is I want to talk about this. People have been, obviously, my apologies for missing this right here. My apologies. Okay, let's go to the VIX. VIX. and you want to go down to the CBOE, okay? You want to use that one. Now, looking at the VIX, I'm going to go to the daily here so we can see this. Just got to click a button, clean this up. Now, I heard a lot of people talking about this today. Yesterday, remember when we were talking about the VIX? The VIX jumped up yesterday. Pretty big. Pretty big. Let me pull this up just a little bit here. Now, the VIX, it fell today, right? It was down 1.44%. And I hear people say that since the VIX fell today, that must mean that people aren't worried. That people aren't worried. Well, let's talk about this for a moment. Yesterday, the VIX popped 8.3%, okay? It got up to 22.2. Today, it pulls back 1.4% to 21.8, right? So the VIX also fell back to stay connected to its 5-day EMA. And it closed above 20. This slight pullback, it may give some market participants a bit of confidence and a sign to be optimistic about the downside risk potentially being priced in by Monday's pullback in equities. However, I would add that we could continue in a choppy, range-bound market or possibly even set a bull trap. Just because the VIX pulled back 1.4%, it is still above 20, which means volatility is here. It hasn't disappeared, okay? Just because it pulled back after a big move up, over 8%, 8.3% pop, and then it pulls back 1.4%, that's so it can stay connected to that 5-day EMA. So I'm not worried about this. But I know I've seen some headlines about, oh, the VIX pulled back. That means people are optimistic about any downside risk for the rest of this week. It's already been priced in. The risk for this week, it's done. It's priced in. You may look at that and think that in combination with equities reaching their lower end of the weekly expected move and thinking, okay, we're good. This is the low for this week. We've made it. But in a bear market, it's different from a bull market. And we've seen it many times this year when there's a 2 sigma move, meaning the market breaks the weekly expected move. It goes lower than it, or it goes higher than it. That's because of the volatility. The options market does a great job of catching that volatility, especially in a bull market. It's got a 68% win rate. But in a bear market, that's where the other part, the fail rate, comes in a little bit more than the win rate. I hope I'm making sense with that. I'm getting that point across. Just because the VIX pulled back today, it's above 20. It's still volatile. Okay, we're still in a very volatile setting. All right, let's keep moving. Did I mess up my chart? Yeah, I want to leave this chart. I want to go back to my other chart that I have. I want to look at the 5-minute chart now for oh yeah, TradingView's got a okay. Where's the X to get rid of this? Okay, come on. I just want my chart. Okay, let's Let's do this one more time. Okay, well, while we're doing this, I see your comment there. What type of stocks move first after a recession? Any examples? Thank you. Absolutely. Actually, let me put this on the screen. We can talk while TradingView is trying to sell me on their Cyber Monday sale, even though it's Tuesday. I just got to wait for this to load. While we're waiting for this to load, let me open this up right here. The market cycle. This is the answer to your question. Okay. So cleaning up the chart here real quick. Just let me clean this up. So right now, looking at this chart right here, the orange line is like the stock market, equities, right? The blue line, that is the business cycle, okay? There's about 6 different stages to the business cycle. Right now, I believe that we are somewhere, let's go over here, somewhere right here, okay, on this side. I think we are somewhere right here. We are in phase 6, the last phase of the business cycle, okay? The stock market, it's down big, it's in a bear market, and the business cycle is turning over. What does good right now? Utilities, real estate, financials. You can even comb in healthcare into this, but utilities, real estate, financials, they do good in this part or this cycle, this part of the cycle. Okay. So if we go and TradingView is still not loading for me. Oh, I want it to load so we can get to what I want to talk about here. Okay, come on, TradingView. My apologies for this. I don't know why it's acting this way. Okay, now that we're down here and we're not in that sale part, I think that sale part was messing it up. Okay, I just want to open this up, the actual chart here. Okay. All right, let's see here. Can I'm just learning. Okay. I'm playing around with this kind of like in real time right now. And I want to, all right, so let's just do this. All right. Let me go back to that real quick. All right, we'll do it this way. Okay, what does good when we are in the 6th phase of the business cycle? Financials do good, real estate does good, utilities do good. All right. Look at today's market. What did good? Financials did good, right? The financials block is green. All right. Utilities. Let's find you. Utilities are down here. A bit of a pinkish red day, meaning things were down like 0.5%. Gray box means pretty much neutral, and a couple of green. So utilities, financials, and then real estate was another one. I'm looking for you, real estate. Where are you? Real estate. Am I just overlooking it? Okay. I don't see real estate here. Okay. I'm just missing it. All right, silly me. Okay, so when you're looking in financials then, okay, and I think that we can click on this to open this up larger. So we have financials. So this is by market cap, all right? So Berkshire Hathaway, right, is top, BRK.B. You got JP Morgan, JPM, right? Up 1.6% today. Morgan Stanley, MS, WFC, as well as Fargo, BAC, Bank of America, Charles Schwab, Goldman Sachs, American Express, Citi. You got a whole bunch of others, PNC, a bunch of bank stocks, right? In here, financials in here. These, looking at the more mega cap, like JP Morgan, Wells Fargo, Bank of America, Morgan Stanley, those are ones that typically perform well in this last stage, okay? And obviously, they have been performing really well. Okay, let's go back. I want to open up utilities. Utilities is also a defensive sector. When there is risk off in the market, people typically will run to defensive sectors. Utilities is one of them. Healthcare is a defensive sector. So that's where people run. So here in utilities, NEE, quite frankly, I'm not even sure. Is that Next Era Energy? I believe that's Next Era Energy. Market cap of 163.9 billion. And then DUK, I believe, is Duke Energy, right? D is Dominion Energy. People run to utilities as a defensive sector, and in this specific cycle, because they're consistent, right? The government says how much they can charge, so everything to a point is predictable. That's why it is a defensive sector and a place where people go when the economy starts to struggle. All right. So let's go back to this. So let's look at the next thing. So as we exit phase 6, then we go back over here to the left side of the chart. Okay. And let me just draw a line down here like this. This is stage 1 right here. All right. When we enter 2023, we could be entering into, oh, I didn't mean to move you. When we enter into 2023, we could be entering into stage 1 of the business cycle. Okay. That's what we could be doing. So what works well here? Typically technology, because we're looking at innovation to get us out of this rut, right? Consumer discretionary. These are all sectors, by the way. And then you can find companies within the sectors that do good. And then communication services do good. Those are the 3 right there, sectors that do good in stage 1. That's when the market has kind of seen its bottom and it's starting to rise up and move higher. And it's when we are still going down in the business cycle. We are in a full recession, but we're not at the deep, dark end of the recession yet, okay? That could come. Obviously, it's right here on the chart, that bottoming part. That could potentially come, I don't know, somewhere between Q2 of 2023, maybe Q3 of 2023. It just depends on how bad things are going to get. That maybe we could reach this bottom right here in one of those 2 quarters, okay? It just depends on how bad is it going to get. And one thing to tell you how bad it's going to get is look at the financial crisis, 2008. How bad were things in 2008? They were pretty bad. Well, look at how much debt we have today versus how much debt we had back in 2008. Drastically more. Way, like you can't even define how much more. That means this recession could be even worse than 2008. And is the Fed going to continue to push to fight inflation? Or are they going to soften up? Are they going to turn more dovish? Stop raising rates, maybe at their first meeting of 2023, which is February the 1st. But anyways, when we get into Q1, Q2 of 2023, technology, consumer discretionary, and communication services do well. So let's drop this back down now. So as we get into Q1, we have technology, right? How's Microsoft, Alphabet? What's Apple going to do? Honestly, I tend to think that looking at earnings now and looking at what's happening now, when it comes to technology, let me bring this chart back up. Maybe technology this time around, maybe it gets pushed back a little bit, okay? And it's not front and center. Or maybe my thought on the first part of the cycle in the business cycle and market cycle, maybe it's not in Q1, which I should have put right here, Q1. Maybe it's not Q1. Maybe that gets pushed back to Q2. And then after an earnings recession, after Q1 earnings have come out, brought these companies down even more because of an earnings recession, maybe that's when we move into phase 1 of the business cycle. So the timing, I don't have a crystal ball. I don't know. But we are probably somewhere either near the tail end of this. That's where I think we are right now. And then it's Q1, Q2 of 2023. I think that's when we hit the first stage of the business cycle. Okay? So don't nail me down here on a specific quarter on where we are on the business and market cycle, because the timing could be off a little bit, right? Just like when we have used the seasonality chart, right? These bottoms, right? We had the June bottom, we had the September bottom, and we had the October bottom. They weren't exactly precisely lined up with that time frame, but they did occur in the month that they were supposed to. Okay? But they were just a little bit off, maybe by a couple weeks forward or backwards on when it occurred. But it did happen within the month that it should have. And it did. So with the business cycle and market cycle, I do believe we're at the tail end. Utilities, financials, real estate. But that's starting to wane. And we're starting to head into the first stage, which I believe is Q1 or Q2 of 2023. Okay? I hope that helps, okay? And then if you want to go into TradingView, just go tradingview.com. I don't think I have a link in the description anymore. But when you go to TradingView, if you scroll all the way down to the bottom, you can see stock heat map. And when you're on that, you can go to the different sectors. You can click on them, you know, like, let's see, let's pick one. We want to go, well, I'm here. We've already clicked on it once. Go to financials. And then you can start exploring all the different companies within the financials here. You can go to small caps, which would be smaller the square, or go for some big caps. Click on it, explore that company. They even have information on the company, an interactive chart you can use, and then you can actually go to a more advanced chart. So there's a lot of tools that you can use right here on TradingView. So I hope you do take advantage of that. And I hope this helps to answer your question about the stocks that move first after a recession. Well, I've kind of been giving examples of we're not in the recession yet. If real quick, because I totally have been talking about where we are right now and when I think we're going to get into the full recession, Q1, Q2 of 2023. I totally missed that you said after the recession. So after the recession, the early recovery, that's when you're at industrials. I should change the color of this. And it's going to make total sense for why. Industrials, materials, possibly energy. Why? When the economy starts to pick back up, right, after the recession, you need materials for the industrials to build things, right? Industrials need the materials to build things. Both need energy and able to get the materials, whether it's gold or silver or copper or tin or anything like that, and then give it to the manufacturers, the industrials, to start building it. Both take energy. Then you need transportation to start shipping it out to all the retail locations or to the customer's door. That's why these things do great at the end of a recession, when we are finally getting into the recovery phase. And it's really easy to follow. Follow transportations, follow materials, follow industrials. Those three are the key for when we're finally in the recovery phase. If you look at materials and industrials right now, they're not doing so good. Transportation, not doing that great. I mean, listen to what FedEx has said about their earnings. It's going to get bad. Really bad. And the economy cannot get better until transportation is better. Transportation can't get better until industrials and materials are better. So follow those three categories: materials, industrials, transportation. Okay? It maybe, if you want to, look up Dow theory. Very interesting, because it talks about this. Transportations are a very leading indicator on the economy. Okay, let's see here. Did I miss anything? Yeah, if you TradingView is running a special right now where you can sign up and you can get a free month with doing it. I believe they're offering yearly plans, and you get in the yearly plan, you get 13 months. So the 13th month or the first month, however you want to look at it, or any month in between, for that matter, is free because you're paying for 12 months now. And I think I read that you could pay for up to 3 years to lock in this discounted rate, and it is a pretty significant discount rate. And that's what I was thinking. I'm probably going to assume that's what you were talking about, whether Q1, Q2 timeframe when we enter or end or the recession there. Let's see here. How many people are going to pay bills with mini bills, credit card debt? Yeah, credit card debt. Debt has ballooned, right? Every month, especially Visa and MasterCard over here in the communication services over here with Visa and MasterCard. There's a report each month that shows credit being used by the consumer, and it's just been growing, right? This to me says the consumer is getting weaker. Okay, they have finally run through any savings that they had during the pandemic with the stimulus and so forth, and they're now back to paycheck. Some of them may not want to downgrade their lifestyle because maybe they upped it a bit during the pandemic, and they just haven't gotten their house in order yet, and they're starting to use that consumer debt, paying with credit cards and so forth, which isn't going to help their situation. So we are headed for some pretty rough times going forward, and my heart breaks for those. You got to get your house in order, and it should be in order now, ASAP, right? Pay off those. If you have credit cards, start with the highest interest first, pay those off first, and work your way down on that interest rate, and go towards the lower interest rate credit cards last. Also, credit card utilization, you want to keep that 30% or lower. That would help your credit. Anything over 30%, and that starts to ding on your credit. So get your house in order. This is what my belief is. When times are good, money's flowing in, times are really, really good, that's when you need to start building that cushion, right? Have 1 month of money set aside that you can cover your bills for a month. Then go to 2 months. Then go to 3 months. Have enough money set aside that if an emergency happens, you can pay your bills for 3 months. You can take that as far as you want, right? You want to invest your money, right? Don't go out and buy that extra coffee Friday afternoon because you're feeling drowsy. Save that $5, invest it. Every dollar that you can spare to invest every week, every 2 weeks, every month, do it. Okay. It'll make a huge, huge, huge difference. And if you don't know where to go, just start putting it in index funds, right? SPY. You can go right there and just invest it there. Certain brokerage firms allow you to buy fractional shares. You don't even have to buy a whole share. So start investing. Put it in a routine, right? That you're doing it over and over and over again. It will help tremendously. So you're doing this during good times. You're preparing your house for those bad times. You're getting yourself in order and situated. So when those bad times come, you are absolutely ready to go. Okay. So just keep those few things in mind, put them to practice. But yeah, unfortunately, many consumers out there are getting themselves set up to be in a bad situation. Okay, let's see here. Credit cards, yeah, and no job. Yeah, it's hard to pay credit cards when you don't have a job. Hard to pay anything when you don't have a job. Let's see here. I heard of the news that credit card debt is down, but I can see it rising fast. Yep, absolutely. Okay, so I think we're good there. Let's keep moving on. The top back over here, I wanted to talk about, as a matter of fact, I can close out this heat map. I want to leave that calendar up there for a moment. Okay. Where are all my lines and everything? What did you do, TradingView? I can't believe it. Did TradingView really just take my lines away? No, it got to be saved. It never does this. I have it saved. What in the world? Okay, well, I've got a little bit of a blooper right now. I wanted to talk about the 5-minute time frame here on the SPX. I can't believe all my lines are gone. Anyways, here's what I did today, right? I've got today on, look at the spike in volume candles down here at the bottom, right? The one to the left, the red one, that cuts off yesterday and it starts today. And then of course we have all the way to the right today. What I did, and I'll just do it right now, I put an anchored VWAP on yesterday. So Monday the 28th at close. All right, that's that one. And then I put another anchored VWAP on this morning, the 29th, the opening candle. I used that anchored VWAP to look for trade ideas today. To use that, and I do it frequently, I attach an anchored VWAP to the close of the previous day and the open of today. Now, when we broke above this and we went and we were up here testing, the weekly expected move was like, and I got to get my, well, let's just do it this way. The weekly expected move was right around here. Bam. It was right around there. So we tagged it, stayed above it, and then once we broke that anchored VWAP with this big candle going down, let me get my highlighter. It makes a little more sense. Once we broke it right here with this big candle, I knew we were going to go lower right there. So hopped in there, went down, set my stop loss, excuse me, and then ended up getting out somewhere around here when it came back up. Good. Was watching. I started with up here, okay? I attached a trend line using these two candles here and here in their tops, and then drew a trend line down, which came something like that. Then once we were on our way back up, I took this and made a trend line with those two, just to kind of see where are we going, what boundaries are we setting. Started riding up, moving sideways, ended up getting stopped out during the sideways move, made a bit of a profit there. And then we found some resistance right here and then fell, okay? There was nothing that made sense today with today's candles for this fall. It just happened to fall. We were going back and forth, rallying back and forth. But at the end of the day, I found this interesting. We were using the weekly expected move on the lower end and the anchored VWAPs to a certain extent especially, and let me just do this, click on it, boom, especially yesterday's close anchor VWAP as resistance. So is the weekly expected move going to be resistance, meaning we are going down lower? Are we going down lower this week? It all depends on Jerome Powell. It all depends on him. What is he going to say? Is he going to be ultra hawkish and come out and just say, you know what, guys, you market participants, you've been rallying this market way too much here. And sorry, got to do it. I need to take back over the reins. You guys have messed it up. You guys have absolutely messed it up with this rally that you have been in. Because look at this. We have been in a rally for a while now, right? Boom, 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 boom. Just like that. So Jerome Powell could come out and tell us, excuse me, enough is enough with this rally. He could be ultra hawkish, really hawkish, and he could just douse any hopes of a continued rally. That could happen tomorrow. All right, let's go look at the dollar right quick. The TradingView, remove all my lines here too. Man, I'm going to be bummed if my lines got removed. Like, seriously, because that's hours of hard work getting everything mapped out. Oh, I can't believe this. Oh, my goodness. Hopefully I can refresh, reset things after the live stream, and it'll be back, because that's something. All right, now let's talk about the US dollar for just a moment. It touched its 200-day moving average. I know it's not visible. It's not here right now because for some reason everything is gone. Even volume, MACD, RSI, all gone. Oh my goodness. But anyways, it touched it yesterday. It found support on the 200-day moving average. We've been talking about that for a while now, and it bounced off of that level today. It ended up down slightly, but not by much. You can see right now it's at 106.6, right? That kind of 105 even is a very important level. And of course, the 200-day moving average is also important. So bouncing off of that is excellent for the dollar. That is negative for equities because there's the inverse correlation. Okay. So the touch on the 200-day moving average and the bounce off of that, that was the first time since June that the dollar has touched and bounced off the 200-day moving average. That's a 200-day simple moving average. That's interesting. Now, since early November, we have also saw the first big upward move in the value to growth ratio. Value has been stealing the show of late, but growth today, interestingly, took over. Something of note. Also, the Russell 2000, which is the IWM, the ticker IWM. This is your small caps. With the value to growth ratio leaning towards growth today, this helped small caps, ticker IWM, with being the only equity index to post real gains today. It was up 0.3% today. Okay. Then we have treasury yields. Treasury yields were up basically across the entire curve. The yield curve is not getting better. It is only worsening. Thank you, Mel. I will log back in and log out. I'll also shut the Pixel book down, and I'm sure they'll be back. I've had lines disappear one time before, and I've been able to get them back. I just don't remember what I did to do so. But thank you for that suggestion. I will definitely be doing that after the live stream. Okay, now let's head over to oil. US OIL. Why am I going to oil? Because oil had another adventurous day. Remember yesterday, oil had an adventurous day. Well, what? Why is it USA only? I mean, it's just all sources. I mean, US oil is, oh my goodness. I've done something here to TradingView. It must be mad at me right now. Okay, but anyways, okay, all kidding aside here. Oil had another adventurous day on the rumor mill, okay? And it is related to the upcoming OPEC Plus decision. And the decision was in full bloom, the rumor about that decision. Throughout the day, we heard varying stories about what to expect. At this point, the final say in play right now seems to be a hold on production levels. They're not going to increase and they're not going to decrease the production levels. They're going to hold them still and steady for right now. Now, there is a virtual meeting expected on Sunday. So on Monday, we should have some clarity around OPEC Plus. Okay, let's go look at the economic data. All right. So we've got, I can't get back to November 29th there. So I'll mention it and then we'll go look at November 30th tomorrow. We got consumer confidence read today for November. It came in at 100.2. The expectation was 100 points even. The prior reading was 102.2. So it's gone down. Not as low as the expectation, but really close to it. So what's the takeaway here? The takeaway is that inflation and interest rate hikes continue to pressure consumer confidence. Intentions to buy homes, buy automobiles, or really any big ticket applications, appliances, any big ticket item, they've cooled off, according to this report about consumer confidence. Meanwhile, and this is important to note because we are seemingly headed in this direction, a reading below 80 for the expectations index, that suggests the likelihood of a recession remains elevated. A recession remains elevated. Consumers see the writing on the wall too. It doesn't take people who study the markets or finance. It's the everyday person. They feel it. They know it. Now, market participants will receive the following economic data tomorrow. Let's talk about it. On TradingView, they have this little fiery flame here, right? When it's red, that means it has more weight and it can have the potential of moving the market, okay? So for tomorrow, 8:15, and these are all Eastern times, okay? Eastern Standard Time, East Coast time. That's where I'm at. ADP employment change. This is kind of a lead up to the employment situation that we will receive, that data, later this week. This is like the pre-run of it, the warm-up to it, okay? So when you click on it, you get a little description of what's happening. The report is based on the actual payroll data from about 25 million employees and is processed by the ADP Research Institute in collaboration with the Stanford Digital Economy Lab. Okay, so it's actual payroll data. This is why this is like a precursor, a warm-up event, a pre-event to the employment data that we will receive later this week. So that's tomorrow morning. Red flame. That means it's super important. Now, when we get this orange flame or a yellow flame, that means it's not that important. It won't have, or it shouldn't have, a major impact on the market. The next flame is here. This is the GDP growth rate quarter over quarter, second quarter estimate, okay? Oh, excuse me there. This is a big one. It comes out at 8:30 a.m. Eastern. Now, I don't really need to go into this. We know it. Here's the forecast, 2.7%. Remember, the prior quarter was a negative 0.6%. So this quarter is expected to grow at a rate of 2.7%. Okay. Now, as we get into 2023, I believe we're going to go back to negative quarters. This is going to be one heck of a recession. That's what I'm starting to formulate my hypothesis for 2023 in the markets right now. And it just seems like this is going to be the worst recession in my lifetime. Okay. I think it's going to be rough. Just look at the amount of debt. It's horrible. Absolutely horrible. Okay. We can scroll down on this list for tomorrow. We also get Chicago PMI, pending home sales, wholesale inventories month over month. But those are all orange flames, so they're not that important. Pending home sales. So there's some housing market data, right? And we talked about housing market on Monday and how the options market is really pricing in volatility for the housing market with wild swings, okay? But the JOLTS comes out tomorrow at 10 a.m. This is the job openings report. The last reading was 10.7 million jobs. The forecast is 10.3 million jobs. Job openings right here, ladies and gentlemen. 10.3 million jobs opened is the estimate. All right. So that's a red flame, 10 a.m. All right. And then a few more things. There's Fed speak, but the big Fed speak is right here in this big red flame. This is Jerome Powell. Okay. Jerome Powell. Oh boy. Tomorrow afternoon, he is the biggest threat to tomorrow's price action. Okay. The words that he uses and how he uses those words, well, they're going to affect tomorrow's market. Now, something that's cool I like about TradingView is you can click here and you can add them to your Google Calendar, or you can click to open up the chart of the economic report. So, for example, when I click on for Jerome Powell, it's going to take me to the Fed funds rate. Okay. And it's going to show me how fast the Fed funds rate has increased this year, nearly straight up. Look at that, ladies and gentlemen. This is, and the ticker for this is USINTR. Okay, this is the Fed funds rate. Right down here, we are at 0 to 0.25%. So 0% to 0.25%. There's always a 0.25% wiggle room in the rate. All right. Right now, look at this. We've gone from basically 0% straight up this wall to 4%. If we go up by 50 basis points, that's 4.5% in 2022. 0 to 4.5% in 2022. That rate of change is huge. Okay. Usually, and let me take this highlighter off here so you can see. Look right here. This was the last time rates were raised. Okay. And it was like steps, right? They'd go up, they'd let it ride for a few months, they take it up again, let it ride for a couple months, take it up again. You get the picture. It was like a step, gradually taking it up. And these basis point raises, all right, the first one was, let's see, 0.25%. So 0.25%. The next one, 0.25%. 0.25%. 0.25%. 0.25%. 0.25% again. And I bet you the last one's 0.25%. Yep, 0.25%. So this started back here. The very first rate hike, okay, was boom, December 2015. So it went from 0 to 0.25% to 0.25% to 0.5%. Okay. December 2015. They finally stopped raising rates. Remember, 2015, they did their last rate hike in December of 2018. And it was another 25 basis point rate hike. So from 15, 16, 17, 18, 19, it took them 4 years to go from 0 to 0.25%, all the way up to 2.25% to 2.5%. Or a better way to say it, it went from 0.25% all the way up to 2.5% in 4 years. Look at the rate of change here. The first one occurred in March, right? Yep. So March 2022, all the way up to November of 2022. So we're not talking 4 years there. May, June, July, August, September, October, November, 8 months. So not 4 years, but in 8 months, we went from 0 or 0.25%, 0.25%, all the way up to 4%. The rate of change is ridiculous. If we go back and look here, let's go back here to 2004. I mean, look at this. It's still stepped. It's not straight up. But if you want to go back to Paul Volcker, going back to the late 70s and into the 80s, there's Paul Volcker right here. Paul Volcker did this. Took rates to over 20%. the Fed funds rate was over 20%. Do you think Jerome Powell has it in him to go Paul Volcker? I'm not sure. He's quoted in his one of his most recent speeches, maybe a couple months ago. His FOMC press conference. He quoted the title of Paul Volcker's recent book. He's trying to present himself as a Paul Volcker, where he is going to stomp out inflation. But there may just be too much debt. So, anyways, this is just more stuff to add to our list that we're going for a deep hole in 2023. We thought 2022 was rough. We ain't seen nothing yet, ladies and gentlemen. Okay, let's see here. This market is a crybaby when it comes to oh, you got me. That was a good one. That was a really good one. That was a really good one. Oh my gosh, I think I got a tear. That was so good. That was really good. Oh man. Oh me, oh my. That was awesome. All right. Well, that's it for my notes for today. I'll go ahead and wrap it up here. Thank you guys for being here with me. Tomorrow is going to be a radical day. Today was like this this calm, cool day, waiting for tomorrow. So buckle up. Volatility is just going to be crazy tomorrow when Powell starts to speak. It is going to be earth-shaking for the market. Okay, it's just gonna move and move and move, and it's going to be erratic. It will not be logical. It is just going to not make any sense. Put your anchored VWAP on tomorrow's open and yesterday's close. Okay, and then put another anchored VWAP when Jerome Powell starts to speak and the market, the first reaction the market makes, put an anchored VWAP on that exact time, okay? That'll be important, okay? That'll be important to help you trade the chaos tomorrow. Watch the weekly expected move. Watch the 3,900 level. The 3,900 level, even if it's bad news, could be support, okay? 3,900 could be support. It'll be a sticky area that if it is bad news, the market sinks, it could bounce there. And then watch how it plays around with those three anchored VWAPs. That is important, okay, for your, if you are going to trade tomorrow. Be very tactical, small positions, keep that stop loss tight, all right? Keep it tight. Don't lose anything, all right? You guys have your wits about you. You've got your skill. You can do it. I know you can. I'll be back here tomorrow after the market is closed, talk about what happened, why it happened, what Jerome Powell is thinking, and try to make sense of it all to help you understand it as well. So if you could for me, click that like button, share this video with a friend, and if you like the perspective, consider clicking the first link in the description. There's a lot of actionable benefits that you can take advantage of. Let's see here. Did I miss something? Two things real quick. Last thing that excuse me. Last thing, what exactly is Jerome Powell supposed to discuss tomorrow? The we don't have a synopsis of what he's talking about. We do have a title of his presentation. It is the economy, it is inflation, and it is employment. I'm not kidding you. His presentation is about economic conditions, inflation, and the labor market. That's what he's talking about. The Fed has two mandates: to fight inflation and full employment. Unfortunately, they have, in their fight for inflation, they're going to have to cause unemployment to go up. Therefore, not full employment. However, the Fed sees it as we have full employment right now, so we can risk losing or causing the unemployment rate to go up some so we can bring inflation down. But I'm not sure they can bring it down past 4%, stopping at maybe a 5% terminal rate. So a lot of things to watch there. So that's what he's talking about tomorrow. It's just going to be crazy. And then, of course, their monetary policy, because of their two mandates to fight inflation and to have full employment, well, economic conditions, their policy affects the economic conditions that are out there. So the Fed is going to cause a hard landing, causing a recession, and I believe a deep one, because of the amount of debt that we have. So be careful with that. You are absolutely welcome. Thank you. I greatly, greatly appreciate you spending your time with me. Absolutely. Got it. I'm ready for violence tomorrow. As long as it's with the candlesticks, then we're cool. Yeah, it is just going to be absolutely bonkers tomorrow, and it probably won't make sense. But who knows? Who knows? Maybe he'll come out and shock the market in a completely different way. You know, it's really up to Jerome Powell and what he says and how he says it, and how the market will act emotional first. Remember that. It will act emotional first before it acts logical. Keep that in mind. Okay, I think that is everything. So thank you so very much for being here. I greatly appreciate it. I will be back again tomorrow after the market closes to talk about what happened, why it happened, and what to expect going forward, and try to make sense of Jerome Powell. Click the like button, share this video with a friend. That's greatly appreciated. And if you like the perspective, you want more, click the first link in the description. And there's a ton of great benefits, and they are actionable. All right. Well, thank you, ladies and gentlemen, for joining me this evening. I will see you tomorrow. Have a good day tomorrow. Good luck with your trades. And yeah, have a good night.